Okay, let's unpack this. Imagine a world where some of the most potentially lucrative investment opportunities are hidden behind a velvet rope, completely inaccessible to the average person.
Mm,
What if you could tap into massive real estate deals right here in the US, the kind institutions usually play in, but only if you meet a certain rather high financial standard?
right, like a members-only club.
Exactly.
Yep.
What if the rules for getting in just felt a little skewed? That's the world we're stepping into today.
Yeah, and we've taken a stack of your sources, really digging into everything from the official legal definitions and, detailed evaluations to some pretty frank real-world experiences shared online.
So our mission in this deep dive is to really understand this exclusive landscape of private real estate funds and, critically, who gets to be part of it.
Mm.
So the focus of this deep dive is private real estate funds in the U.S. and the concept that acts as the ultimate gatekeeper, the accredited investor.
We're going to pull apart what that term actually means, why it's so powerful and necessary in this particular market, how these funds actually work on the ground.
Yeah.
And just as vital, cut through the hype to look at the significant practical realities and often overlooked downsides you absolutely need to grasp before even thinking about putting money into this space.
Our goal is to synthesize everything we found, cut through the jargon, and give you a clear, informed perspective on this part of the investment universe. We want to extract the essential insights and hopefully share some surprising details that give you a true picture of what it's like behind that rope.
And to do that, we absolutely have to start at the gate. Understanding the accredited investor status is, well, it's the prerequisite to accessing these opportunities.
Right, it's the key that unlocks the door. So, straight out of the sources, what is the official regulatory definition of an accredited investor?
Okay, so that definition comes directly from the Securities and Exchange Commission, the SEC, here in the United States.
Yeah.
It's detailed under the Regulation D, specifically Rule 501.
Rule 501, got it.
And the core idea is that an accredited investor, whether an individual or an entity, is deemed by the SEC to be financially sophisticated enough and to have sufficient financial capacity.
Okay.
That they have a reduced need for the protection provided by regulatory disclosure filings.
Reduced need for regulatory protection. That sounds significant. What does that actually translate to in practice?
Well, it means these investors are considered capable of evaluating the risks involved in investments that don't undergo the standard, often extensive SEC registration and public disclosure process.
Uh-huh.
This status permits them to invest in what are often termed complex or sophisticated types of securities that are not closely regulated or simply unregistered securities. We're talking about things like private placements, certain hedge funds, private equity, and yes, private real estate funds.
Okay, so the regulator's essentially saying, you're wealthy or experienced enough to handle this yourself. We're not going to provide the same level of detailed government oversight you'd get in the public stock market.
Precisely. That's pretty much it. The intention is to ensure that participants in these potentially riskier, less transparent ventures have the financial cushion to withstand potential losses.
Right.
And the knowledge to conduct their own due diligence without the government mandating as much upfront disclosure. They're expected to be able to fend for themselves, as the phrase goes.
Got it. So for individuals listening, what are the most common ways you actually get this status? How do you qualify based on the SEC rules?
The two primary paths for individuals involve either income or net worth.
Uh-huh.
First, let's look at the income test.
Okay.
To qualify this way, you must have had an annual income exceeding $200,000 as an individual,
200 grand.
or $300,000 if you're combining your income with a spouse or domestic partner. But, and this is important, it's not just a one-year thing. This threshold must have been met for the last 2 consecutive years. And crucially, you also need to have the expectation of earning the same or even a higher income in the current year.
2 years straight and expect to keep it up.
That 2-year history plus the forward expectation are both absolutely necessary.
Yep, that's clear. What about the net worth side of things?
Okay, the net worth test requires you to have a net worth exceeding $1 million.
$1 million.
This can be calculated using either your individual assets and liabilities or combining yours with your spouse's. Now, here's a critical exclusion that often trips people up.
Uh-oh.
You absolutely cannot include the value of your primary residence in this calculation. Your home equity doesn't count towards that $1 million threshold.
Whoa, okay, so assets minus liabilities, but you have to subtract your house and its mortgage from the equation first?
Exactly. Your primary home is just carved out completely. And one of the sources provided a really helpful example to illustrate this calculation.
Oh, good. Let's hear it.
They describe someone whose income is, say, $150,000 a year for the last 3 years. Right away, they don't qualify based on income because they haven't hit the $200,000 individual or $300,000 joint threshold for 2 consecutive years.
Okay, income test failed. But let's see how they fare on the net worth side using the example.
Right. So the example person owns a primary residence worth $1 million with a $200,000 mortgage.
Yeah.
But we ignore that, set it aside.
Ignore the house. Got it.
Their other assets are listed as a car worth $100,000.
Nice car.
With a $50,000 car loan, a 401k account valued at $500,000, and a savings account holding $450,000.
Okay, so their assets, excluding the primary residence, are $100 for the car, plus $500K in the 401k, plus $450K in savings. Let's see, that adds up to $1,050,000.
Correct. And their liabilities, excluding the primary residence mortgage, are just the car loan of $50,000.
So assets, $1,050,000 minus liabilities, $50,000 equals exactly $1 million. Right?
Precisely. Bang on. Even though they didn't pass the income test because their net worth, excluding their primary residence, hits that $1 million mark exactly, they do qualify as an accredited investor under the net worth test.
Wow.
That example is a perfect way to see the calculation and understand that key exclusion.
That's a really concrete illustration. It shows it's not just about high income. Hitting that $1 million plus net worth outside of your home is a very common path. Are there any other ways to qualify besides just meeting these specific financial thresholds?
Yes, definitely. The definition has evolved, particularly with amendments made by the SEC in 2020. They explicitly expanded the ways individuals can qualify to include those based on professional knowledge or specific experience.
Okay.
Recognizing that financial sophistication isn't solely tied to, how much money you have.
Professional knowledge, like what kind of knowledge or experience?
Well, the rules now include individuals who hold certain professional certifications, designations, or credentials that the SEC recognizes as demonstrating the necessary level of financial sophistication.
Such as?
Specific examples mentioned are people who hold FINRA Series 7, Series 65, or Series 82 licenses.
So folks already licensed to work with securities or investments, that makes intuitive sense.
Right. It also extends to knowledgeable employees of the private fund itself, people working directly within the fund who understand its operations and risks.
Inside knowledge.
Yeah. Additionally, individuals who are already registered with the SEC or state securities regulators as investment advisors qualify, as do those affiliated with the issuer of the unregistered securities, things like general partners, executive officers, or directors of the company making the offering.
So if you're already deeply involved in the financial industry or the specific company raising the capital, you might automatically meet the standard. What about entities beyond individuals like companies, trusts, or other organizations?
Entities can definitely qualify. The rules include private business development companies and organizations that have assets exceeding $5 million.
$5 million in assets.
Also, an entity can be considered accredited if all of its equity owners are themselves accredited investors. However, there's an important safeguard here. An entity cannot be formed solely for the purpose of purchasing the specific securities being offered.
Can't game the system that way.
Exactly. That would be seen as a way to bypass the rules.
Okay, so it's a standard that applies to certain types of sophisticated organizations as well as wealthy or experienced individuals. Now, you mentioned you don't apply to the SEC for this. How is this status actually verified in practice?
That's a key point. You don't fill out an application and get like a card from the SEC saying accredited investor.
Right. No membership card.
No. The responsibility for verification falls squarely on the shoulders of the company or fund that is offering the private placement. They are legally required to take reasonable steps to verify that every investor they accept is indeed accredited.
So the burden is on the seller to make sure the buyer is qualified.
Precisely. This verification process is essential because it's what allows them to rely on the exemptions from full SEC registration. They have to demonstrate they sold the unregistered securities only to the eligible class of investors, the accredited ones.
What kind of reasonable steps or documentation do they typically ask for to prove your status? If I wanted to invest, what would I need to show them?
For the income test, they'll usually ask for things like income tax returns for the past 2 years, W-2s, or maybe pay stubs.
Okay. Proof of income.
To verify net worth, they'll typically request account statements for your assets and liabilities. This could include bank statements, brokerage or retirement account statements, documentation for outstanding loans.
Like the car loan in the example.
Exactly.
Yeah.
And potentially even information on real estate investments you own outside of your primary residence.
That sounds like handing over a lot of personal financial information. Is it always that detailed?
Not always for everyone. The sources noted that for certain individuals whose professional credentials inherently indicate their financial sophistication, like, fund managers or partners in finance firms, or individuals holding those specific FINRA licenses we mentioned, the verification process might be simpler or bypassed altogether, as their status is generally accepted based on their role.
That makes sense. Their daily job is dealing with these kinds of complex finances. So stepping back again, what's the core reason this whole accredited investor framework exists? What problems is it trying to solve from a regulatory perspective?
Well, the fundamental goal is investor protection, but a specific kind of protection. Because these private investments, whether private real estate, hedge funds, or private equity, lack the comprehensive, mandated disclosure documents required for public offerings, like stocks.
Right. Less paperwork filed with the government?
They are considered inherently riskier and less transparent for the average retail investor. The SEC's framework is designed to restrict access to these less regulated investments to people and entities who are presumed to have the financial wherewithal to absorb potential losses without being ruined.
Okay.
And the knowledge to navigate the complexities and perform their own due diligence in the absence of extensive government oversight.
They're expected to do their homework because the government isn't doing as much of it for them with mandated filings.
Exactly. They are seen as having the capability to evaluate the risks and merits on their own. However, it's crucial to acknowledge the perspective, highlighted in the sources, that this requirement, while intended to protect unsophisticated investors, inherently creates a significant barrier. It grants exclusive access to potentially high-reward investment opportunities to those who already possess substantial financial assets, leaving those with more modest means locked out of this particular part of the market. It absolutely establishes a two-tiered system.
It certainly does seem to divide the investment world. Okay, that covers the gatekeeper. Now, let's pull back the curtain and talk specifically about what's behind that gate. Private real estate funds.
Yeah.
What exactly are these?
Okay, so private real estate funds are one of the primary destinations for accredited investor capital in the private markets.
Yeah.
At their core, they function by pooling capital from multiple investors, the accredited ones we've been discussing,
Right.
with the specific purpose of investing in real estate assets.
So it's a collective investment vehicle, but solely focused on property.
That's right. They use that combined capital to acquire, develop, manage, and ultimately sell real estate properties. What makes them appealing is that they can aggregate enough capital to pursue institutional quality deals that individual investors may not have access to on their own.
Yeah, like multi-million-dollar apartment buildings or shopping centers.
Exactly. Think large apartment complexes, office buildings, industrial parks, or significant development projects that are far too large or complex for a single person to tackle.
That makes sense. Most individuals aren't going to buy a distribution center. How does the investment process typically work for someone putting money into one of these funds?
Well, investors commit a certain amount of capital to the fund. This capital is generally illiquid, meaning it's tied up for a significant period.
Illiquid keyword there.
Very key. The fund manager then deploys this capital over time into various real estate projects according to the fund strategy. They actively manage these properties, often improving them or managing tenants, with the ultimate goal of selling them or refinancing them at a profit years down the line.
So you get your money back when they sell the building, basically.
Generally, yes. Investors typically see their primary returns when properties are sold or debt is refinanced, distributing cash back to them, often several years after their initial commitment.
So it's definitely a long-term play. Are all private real estate funds doing the same thing, or are there different approaches and risk levels?
Oh, they are absolutely not monolithic. The sources outlined 5 primary strategies that define the risk and return profile of a fund, moving generally from lower risk and lower potential return to higher risk and potentially higher return.
Let's break those down. What's the safest?
First, you have core strategies. These funds invest in stable, high-quality, income-generating properties in prime locations. Think fully leased Class A office buildings, well-established apartment communities in sought-after neighborhoods, or retail centers with long-term credit tenants.
Okay, steady eddies.
Pretty much. The risk is considered low, And the focus is on generating predictable income streams, almost like a bond yield, but from real estate.
Okay, income and stability first. What's the next step up?
Moving slightly up the risk spectrum is Core Plus. These funds target properties that are largely stable, but might require some minor improvements or active management to enhance value or income.
Like putting in new countertops or something?
Yeah, maybe they'll upgrade some unit interiors in an apartment building or make cosmetic improvements to a retail center. The risk is moderate, combining stable income with some potential for capital appreciation from the improvements.
Adding value through minor tweaks, and then...
Beyond that is the value add strategy. This is where the fund invests in properties that are underperforming or need significant repositioning or rehabilitation.
Okay, now we're talking bigger projects.
Definitely. This could involve extensive renovations, turning around distressed properties, changing the property's use, like converting an office building to apartments, or aggressively releasing vacant space. The risk is higher than Core or Core Plus, but the potential returns are also higher if the manager successfully executes the complex business plan.
Taking something broken and fixing it up? What's on the higher risk end?
At the higher end, we have opportunistic strategies. These funds pursue investments in distressed assets, ground-up development, though sometimes development is listed separately, properties requiring major capital infusions, or assets in less established markets.
Sounds risky.
It is. The risk is high. You could lose a significant portion of your capital, but the potential for outsized returns is also present if everything goes right.
High risk, potentially high reward. And the final category mentioned.
That's development. This involves building new properties from the ground up, constructing residential subdivisions, shopping malls, industrial parks, or office towers.
Starting from scratch.
Yep. This is arguably the highest risk category as it involves entitlement risk, construction risk, financing risk, and market risk from scratch. But successful development projects can yield the highest returns of all real estate strategies.
So accredited investors can choose funds aligned with very different risk tolerances, from low-risk income generation to high-risk ground-up construction. It sounds like, especially for value-add, opportunistic, and development strategies, the expertise of the fund manager is absolutely paramount.
Oh, absolutely. The sources heavily emphasize that the success of these strategies hinges on having experienced, capable fund managers. They're the ones identifying suitable properties, conducting deep due diligence, securing financing, overseeing the business plan, renovations, leasing, development, and ultimately managing the asset to maximize returns and navigate potential pitfalls.
So you're betting on the manager as much as the property.
Arguably more so. Their track record and execution ability are critical.
Speaking of how these funds are put together, the sources mention various structures they can take without getting too bogged down in the legal weeds. Can you give us a brief sense of the different structures they highlighted?
Sure. The choice of structure is complex and balances legal, tax, and operational efficiency. Some examples included are private versions of REITs, real estate investment trusts.
Right, the kind only accredited investors can access, not the ones on the stock market.
Exactly. Totally different beast.
Yeah.
You also frequently see the use of special purpose entities, or SPEs, often structured as property-level LLCs.
SPs.
Yeah, these are crucial for isolating the risk of a single property if something goes wrong with one building. The liabilities hopefully don't spread to the rest of the fund's assets. It creates a firewall.
A layer of protection at the asset level. Makes sense.
There are also structures involving a separate management company or general partner, GP entity. This is often done for tax reasons, separating the management function from the investment fund itself. The fund entity itself can be structured as limited partnership, LP, limited liability company, LLC, or occasionally even an S-corp.
Okay.
Depending on tax advantages and investor preferences.
Different flavors for the fund itself.
Another structure sometimes used, especially for larger, more complex funds, or those with diverse investor bases, including foreign or tax-exempt investors, are corporate blockers, typically C-Corp.
Blockers, why?
These can help shield certain investors, like foreign investors or tax-exempt U.S. investors, from specific tax issues like for PTIO or unrelated business taxable income, UBTI, which we can maybe touch on later.
Using a corporate layer to manage tax liabilities.
Okay, and finally, joint ventures, JVs, are very common. This is when two or more parties, perhaps two funds, or a fund and an institutional investor pool capital for a specific large deal that might be too big for either party to do alone.
Teaming up for the big ones.
Exactly. So managers have a toolkit of legal structures to achieve different goals based on the fund's strategy, investor base, and tax considerations.
Now, when an accredited investor is invited into one of these private offerings, there's a primary document that lays out everything, right? The private placement memorandum.
Yes, the Private Placement Memorandum, or PPM. This is the fundamental legal document provided to prospective investors in a private offering. Think of it as a comprehensive guide to the specific investment opportunity.
Is this essentially the document that provides the disclosure since it's not registered with the SEC, like the prospectus for a public offering but private?
Precisely. That's a good analogy. Because these aren't registered securities, the PPM is the key document. Its purpose is twofold. First, to provide investors with all the material information they need to make an informed investment decision,
Okay.
laying out the terms, the risks, the strategy, and the management. Second, for the issuer, it serves to demonstrate that they have provided sufficient disclosure, thereby helping to mitigate their legal risk under anti-fraud provisions of securities law. It's described as a cornerstone of private fund investment.
So it's about transparency, but also legal protection for the issuer. What absolutely must an investor look for in a PPM? What are the essential components?
The sources highlighted several critical sections. You'll always find an executive summary near the beginning. This is meant to give you a high-level overview of the fund's purpose, key investment terms, target returns, and a summary of the manager's background.
The elevator pitch?
Kind of, yeah.
Yeah.
It's the pitch in brief, but you absolutely cannot stop there.
Definitely need to read past the summary. What's next?
Then, crucially, there's the risk factors section. This is where the fund details all the potential downsides. This can include broad market risks like economic downturns or interest rate changes, regulatory risks, and risks specific to the fund's strategy, the types of properties it targets, or the manager's execution.
The scary part.
It should be thorough. Transparency in this section is vital. You need to see that they've considered everything that could go wrong. You need to understand all the ways you could lose money or not achieve expected returns.
Absolutely. What else?
The terms of the offering section details the mechanics of investing, the minimum and maximum investment amounts, how the investment is valued over time, how distributions will be made, and the rights and obligations you have as an investor, or more likely don't have.
The nitty-gritty of the deal.
Yeah. The use of proceeds section is important too. This breaks down how the capital being raised will actually be spent. How much is going directly into acquiring properties? How much for renovations or development costs? How much is allocated to fees, operating expenses, or reserves? This tells you how your money will be deployed according to the fund's strategy.
Where the money goes. And they'll include projected performance, right?
Yes, you'll find financial projections. These will outline expected performance metrics, commonly including internal rate of return, IRR, distributions, and total value targets, like the equity multiple.
IRR equity multiple. We should probably define those.
We definitely should. But these projections are based on market assumptions, historical data if available, and the manager's model. However, and this is a critical point emphasized in the sources, these are projections, not guarantees.
Say that again.
They are not guarantees. You absolutely must treat them as estimates and understand that actual performance can vary significantly, often to the downside.
That distinction is huge. A projection is a best guess, not a promise.
Precisely. And underlining all of this is the importance of transparency and compliance. While private offerings avoid full SEC registration, the issuer is still subject to anti-fraud laws. They must provide accurate and complete information in the PPM. Misleading investors or omitting material facts can lead to severe legal consequences for the issuer.
So the PPM has to be honest, even if it's not SEC filed.
It has to be. A well-done PPM is intended to create a clear, shared understanding of the investment between the investor and the fund manager.
Okay, so you understand who qualifies, you have the document explaining the deal. Now, how do you actually evaluate these opportunities? It sounds like it's much more complex than just looking at a stock chart.
Oh, it's a completely different ballgame. Due diligence is absolutely paramount, but as the sources pointed out, it's challenging because the evaluation metrics and processes differ significantly from public markets.
Yeah.
You don't have standard, easily comparable data points like you would for stocks or public REITs. While there are dozens of metrics used in real estate, a few were highlighted as critically important for investors.
What are those key metrics we absolutely need to understand?
One foundational one, particularly for properties generating income, is net operating income, or NOI.
Net operating income. What does NOI measure?
Simply put, it's the property's income rent, mainly minus its operating expenses, things like property taxes, insurance, utilities, maintenance. but before accounting for debt payments, income taxes, or major capital improvements.
So like the property's basic profitability.
Exactly. Think of it as the property's raw profitability, usually calculated monthly or annually.
And why is it so important?
Well, NOI is a key indicator of a property's financial health and is a primary input used to determine its value. A property's value is often derived by dividing its NOI by the market cap rate, capitalization rate.
Okay, we'll get to cap rate.
So improving NOI, whether by increasing rental income or reducing operating costs, directly increases the property's value and the cash flow available for distribution.
Got it. The basic income engine of the property. What's another critical metric? You mentioned IRR.
Yes, internal rate of return, or IRR. This is a widely used metric to measure the compound rate of return of an investment over its entire holding period.
That sounds a bit technical. How does it work?
It can be. Technically, the IRR is the discount rate that makes the net present value, NPV, of all cash flows, both money going out, the initial investment in any capital calls, and money coming in, distributions in the final sale proceeds, equal to zero. The key is that it accounts for the timing of those cash flows. Getting money back sooner improves the IRR compared to getting the same total amount back later.
Time value of money.
Exactly. While the definition sounds complex, spreadsheet programs like Excel have built-in functions that make calculating IRR straightforward once you have the expected or actual cash flows over time. The sources even used a simple cash flow example to show how you'd calculate it, illustrating the money going out at the start and then coming back in chunks over several years.
Okay, so it gives you a sense of the project's overall profitability on a time-weighted basis. What about those other metrics mentioned? Cash on cash, cap rate, equity multiple.
Right. The sources also listed those as critically important standard metrics investors evaluate. While they weren't deeply defined beyond being listed as key, let's quickly touch on what they mean in simple terms.
Please do.
Cash on cash return. This measures the annual cash flow distributions you receive from the property relative to the actual cash you've invested up to that point. It tells you your current yield on the money you've put in. Pretty straightforward.
Your annual return on your invested cash.
Yep. Then capitalization rate, cap rate. This is calculated as the property's net operating income, NOI, divided by its market value or purchase price. It's essentially the unlevered yield on the property.
Unlevered meaning without debt.
Exactly. What rate of return you'd get if you bought it all cash. It's a common way to compare the relative value and yield of different income-producing properties in a market. A lower cap rate generally means a higher price relative to income.
Okay, compares property values. And equity multiple.
Equity multiple. This is a simple ratio of the total cash distributed back to investors, including the final sale proceeds, divided by the total cash invested over the life of the deal.
So total money out divided by total money in.
Exactly. An equity multiple of 1.5x means you got $1.50 back for every $1 you put in. It measures total profit relative to total investment, but it doesn't account for how long it took to get that money back, unlike IRR.
Got it. So NOI for current profitability, IRR for the time-weighted return, cash on cash for current yield, cap rate for relative value, and equity multiple for total profit. That gives us a better picture of what to look for in the projections.
Those are definitely some of the big ones to understand.
Now, let's talk about something that came up repeatedly as a major concern in the sources. Fees.
Ah, yes. Fees are absolutely paramount in evaluating private real estate funds, maybe even the most critical factor to dig into.
Really? More than the property itself?
Well, they have a huge impact on your net return.
Yeah.
And sentiment from real-world investors in the online discussions was blunt. Fees were often described as awful and terrible, not just on crowdfunding platforms, but generally in this private space.
Awful and terrible. Strong words.
They are typically higher than fees in public markets and vary significantly from fund to fund. You really have to read the fine print.
What kinds of fees are we talking about?
Well, you'll typically see setup fees, which are upfront and might range from 1% to 2% of the capital you commit.
Be it off the top.
Yeah. Then there are ongoing management fees. While one online source mentioned ranges as low as 0.1% on committed equity, another source, perhaps looking at more active strategies like value add or opportunistic, noted that average fees are nearer to 150 basis points, or 1.5% annually, on committed equity.
1.5% per year just for managing it.
And that's usually paid regardless of performance. You might also encounter monitoring fees or pass-through expenses, although these are often capped, maybe at 1% for pass-throughs.
An annual fee of 1.5% on committed capital can be a significant amount, especially for a large fund. That eats into returns quickly.
It really adds up over the multi-year life of a fund. And then there's the big one, carried interest, often called the promote.
The promote, okay.
This is the manager's share of the profits, typically paid after investors receive a certain minimum return, known as the hurdle rate or preferred return.
So investors get paid first, up to a point.
Usually, yes. There's often a hurdle, say 6% or 8% annual return to investors. After that hurdle is met, the manager gets a slice of the remaining profits. Online discussions mentioned promotes ranging from 10% to 30% of profits.
30%? Wow.
With 20% being a common historical figure, though some private equity real estate funds can command 30% or even more.
So the manager gets a cut of the upside after the investors get their initial return.
Exactly. And one of the sources shared this fascinating historical tidbit about the origins of carried interest,
Oh.
tracing it back nearly 1,000 years to 10th century Venice, and a type of contract called a colleganza.
Venetian merchants. How does that connect to modern real estate fees? Sounds a bit random.
Well, the colleganza was a partnership between a wealthy investor who provided the capital and a merchant who undertook the perilous journey. The merchant would sail across dangerous seas, facing pirates, storms, and disease, literally risking their life to trade goods in foreign lands.
Okay, serious risk.
Immense risk. The contract specified how any profits were split to align the merchant's incentive with the investor's success. This is where the 20% profit share benchmark for the operator, the merchant in this case, is believed to have originated. It was compensation for taking on immense personal, life-threatening risk.
Wow, so carried interest started as compensation for mortal danger. How does that historical context relate to today's private real estate fees? That seems different.
That's precisely where the criticism arises. The sources highlighted the argument that the gap between the life-threatening risk faced by those early merchants and the financial risk taken by modern fund managers for a similar 20-plus profit split is enormous and disproportionate.
So the compensation model persists, but the actual risk profile for the person receiving the carry has fundamentally changed. They're not usually risking their lives today.
That's the core argument from critics. They contend that with large amounts of assets under management, the significant annual management fees, like the 1.5% we mentioned, often become the primary driver of the manager's business and personal wealth, even if the fund's investment performance is only mediocre.
Right, they make money even if the fund doesn't do great.
This setup, especially combined with managers sometimes contributing relatively little of their own capital compared to the fund size, can potentially detach the manager's promote from true outperformance for the investors. Some argue this structure can incentivize managers to simply grow assets under management, gather more fee-paying capital, rather than focus solely on maximizing net returns for investors after all fees.
That's a powerful criticism that the fee structure might reward asset gathering more than generating exceptional returns for the limited partners.
It is. And one source, specifically the RCLCO article, went further and proposed some pretty controversial ideas for reforming fee structures to better align interests.
Oh, really? What were some of those suggested changes?
Well, one proposal was that the hurdle rate, the minimum return threshold investors must receive before the manager earns any promote, should be based on unleveraged returns.
Unleveraged, meaning based on the property's performance without debt.
Exactly. They argued that using leverage can artificially inflate IRRs and trigger promotes sooner, even if the core property performance isn't exceptional. They suggested a minimum unleveraged hurdle of something like 6%, representing a reasonable return expectation for low-risk real estate before the manager gets an extra cut for generating alpha.
Interesting. So measure the performance of the underlying real estate first, without the boost from debt, before splitting profits.
That was the idea. They also suggested eliminating catch-up provisions. Yeah, this is a feature where, once the hurdle is met, the manager gets an outsized share of profits for a while until they catch up to their full promote percentage on all profits, including those earned below the hurdle. The argument is that this feature undermines the very purpose of the hurdle rate, making it less protective for investors.
Seems counterintuitive.
Another idea was that asset management fees should feature significant economies of scale, meaning the annual percentage fee should be substantially lower for very large funds compared to smaller ones,
That makes sense.
reflecting that the cost per dollar managed goes down significantly at scale.
Lower fees for bigger funds makes sense from an investor perspective. Any other big suggestions?
And finally, they suggested limiting the use of subscription lines of credit. These are short-term credit lines funds use to bridge capital calls.
Okay.
Limiting their use strictly to liquidity needs rather than using them strategically to sort of smooth out cash flows or manipulate IRR calculations and trigger promote payments earlier than cash flows from property operations will allow.
Using debt to boost IRR numbers. Okay. Those suggestions certainly sound like they'd face pushback from the industry, but they highlight where some fee structures are misaligned. Were there any other types of fees discussed as potential concerns?
Yes, fees paid to subsidiaries or affiliates of the fund manager were noted as a potential area for concern,
How so?
especially with vertically integrated operators who have their own in-house property management, construction, or development arms. There's a risk they might charge non-market rates for these services to steer profits to their affiliated businesses, rather than getting the best deal for the fund itself.
Self-dealing potential.
Right. The suggestion here was to have upfront rate caps and independent market tests to ensure any related party fees are reasonable and competitive.
Okay, so evaluating these opportunities isn't just about the projected returns and metrics. It's absolutely essential to scrutinize the entire fee structure and understand how it incentivizes the manager. Now, let's turn to the practical side. What are the significant downsides and real-world complexities that accredited investors need to be prepared for when entering this space? This seems crucial.
Yeah, this is where the rubber meets the road. While some sources touch on the potential upsides like diversification benefits, potential tax advantages from depreciation, and the chance for higher returns than public markets, another source, detailing the 18 downsides, painted a very clear picture of the less glamorous realities.
18 downsides. Okay, let's group some of those key challenges together. What's perhaps the most fundamental barrier or risk once you're in?
Arguably, the biggest one is illiquidity. This was universally highlighted as a major con.
Illiquidity, meaning your money is stuck.
Exactly. When you invest in a private real estate fund or syndication, your capital is locked up. For debt investments, it might be 6 to 18 months. But for equity funds, it's typically 3 to 10 years, sometimes even longer.
3 to 10 years or more. Wow.
And critically, if the investment encounters problems, perhaps properties aren't leasing up, or market conditions are poor for selling, the fund's term can often be extended by the manager, potentially for years, delaying the return of your capital even further.
So you absolutely, positively must invest money you do not anticipate needing access to for a very long time. No emergency funds here.
That is the key takeaway. You must be comfortable with your money being inaccessible for years, potentially over a decade. While there's supposed to be an illiquidity premium, higher returns to compensate you for this lack of access compared to public markets, there's no guarantee you'll actually receive that premium in every deal.
Right.
Unlike selling a stock in seconds, you cannot simply cash out of a private real estate investment when you want or need to.
That's a massive point. What about the initial cost of entry?
There are typically high minimums. While you might find some deals with minimums as low as $20,000 or $25,000, especially maybe on some online platforms, they are often in the range of $50,000 to $250,000 for direct deals or funds.
50 to 250K minimum.
And as one source noted, the better investments often have higher minimums, potentially starting at $100,000 or $250,000 and going much higher. This is because established, high-quality managers often already have a network of wealthy repeat investors and don't need to market deals with lower minimums.
So even for an accredited investor, access can still be limited based on how much capital you have. That $1 million net worth might only get you into 1 or 2 deals.
It absolutely can. And it might push investors towards online platforms, which sometimes feature lower minimums, but may also introduce additional layers of fees on top of the fund's fees, so you have to watch that too.
Okay. Illiquidity and high minimums are significant barriers. What's one of the surprising administrative hassles that came up?
Oh, this is a big one for many investors and often unexpected. Multiple state tax returns.
Oh, taxes?
Yeah. Real estate is physically located somewhere, and if the properties the fund invests in are spread across different states, the partnership that owns the property often has tax filing obligations in those states.
Okay.
This typically means you, as a limited partner investor, will receive K-1 forms from each state where the fund operates properties, not just one federal K-1.
Wait, you mean I have to file state tax returns in every single state the fund owns property in, even if I don't live there?
Very likely, yes.
Yeah.
Unless the amounts are very small, but often yes. This adds considerable complexity, cost, and time to your tax filing process. Even if you don't owe money in those states, you often still have compliance filing requirements.
That sounds awful.
It can be. While some accountants might suggest delaying filing until a capital event, it's a common and often frustrating reality of private real estate investing that significantly complicates your tax situation. One source bluntly stated that while real estate has tax benefits like depreciation, it is most definitely not awesome for keeping your tax returns simple.
Ugh, that sounds like a potential nightmare come tax season.
Fair.
Definitely not awesome.
Yeah.
What about finding and comparing deals once you are accredited and have the capital? Is it easy to shop around?
That's another major hurdle. The difficulty learning about investments and comparing them. Unlike public stocks or mutual funds where you have massive searchable databases like Morningstar or whatever,
Right.
there is no central repository for private real estate deals. Every single deal is unique.
So no easy way to pull up a prospectus side by side and compare key data points.
Absolutely not. Information is often opaque. Historically, finding quality private real estate deals has been very network-driven. It's a networker's paradise, requiring you to tap into your network.
We know.
Yeah. Managers using exemptions like 506B cannot publicly advertise their deals, while online platforms using rules like 506C can advertise and provide broader access. They still represent only a portion of the market, and you still have to do substantial, often time-consuming diligence yourself.
And these deals don't stick around forever.
No, opportunities can appear and disappear quickly. And critically, the sources noted that conflicts of interest are pervasive. The people telling you about a deal, maybe even your financial advisor or banker, might have their own financial incentives for recommending it that aren't perfectly aligned with yours. You have to be careful who you trust.
Very careful. Which leads right into the next big risk, right?
Yeah.
Manager risk. This was repeatedly highlighted as arguably the most important factor in private real estate investing. There are no index funds here. You are fundamentally investing in the capability, integrity, and business acumen of the general partner or fund manager.
A good manager can save a troubled deal, but a bad one can sink a good property? Is that the idea?
Exactly. A skilled and ethical manager is crucial for success, while an incompetent or, worst-case, fraudulent manager can be disastrous. The sources underscored that even with the best property, poor management or dishonesty can lead to significant losses. One investor shared a personal story of a manager who committed fraud
by taking out excessive debt without investor knowledge, leading to bankruptcy and losses, a stark example of manager risk becoming reality. Due diligence on the manager is paramount.
But performing thorough due diligence on the manager sounds complicated and costly itself.
It is, and that's the tricky due diligence dilemma. Truly thorough diligence takes significant time and money. It might involve flying to see the property, meeting the manager in person, conducting background checks, calling references, and talking to previous investors.
Yeah, that's a lot of effort.
It can easily cost thousands of dollars and many hours, which can be hard to justify for a typical $50,000 or $100,000 investment size.
So smaller investors might be forced to cut corners on diligence or just trust their gut or network.
Often, yes. Or they rely heavily on managers introduced through trusted networks, which brings you back to the network dependency. And even the most diligent process is no guarantee of success, only hopefully an improvement of the odds.
Okay, let's add that to the growing list. Illiquidity, high minimums, multi-state tax headaches, difficulty finding and comparing deals with potential conflicts, critical manager risk, and the challenge of doing proper diligence. We've mentioned it, but the accredited investor requirement itself can be seen as a downside for those who don't qualify.
Yes, because it inherently limits who can access these opportunities, creating that barrier we discussed at the outset. It means if you haven't hit the income or net worth numbers, you simply can't invest in these specific private placements, regardless of how well they might fit your investment goals or risk tolerance. You're just locked out.
And tied to that, there's the reality of no SEC oversight in the same way there is for publicly traded securities.
Right. This lack of full SEC registration and mandated public disclosures is the reason the accredited investor requirement exists. The government isn't providing the same level of review or protective framework, relying instead on the investor's presumed sophistication and financial capacity.
So less protection, basically.
Less mandated upfront disclosure and ongoing reporting? Yes. While the value of SEC oversight can be debated, its absence is a clear difference from public market investing.
What about diversification? That's usually a cornerstone of prudent investing, but it seems challenging here.
Diversification challenges are significant. especially when investing directly in individual syndications rather than diversified funds, with high minimums typically starting at $50K or $100.
Yeah.
Even a relatively wealthy accredited investor might only be able to place capital in 2, 3, or perhaps 4 deals within their real estate allocation without exceeding prudent position sizing.
And if one of those few deals performs poorly or goes south, your whole real estate bucket takes a hit.
The impact on your overall real estate portfolio and potentially your total portfolio can be substantial. This is a stark contrast to easily achieving broad diversification by buying a single low-cost ETF in the public markets, giving you exposure to thousands of companies or properties instantly for a low minimum. Investors face a dilemma. Invest in deals with lower minimums, which may potentially be lower quality deals or have platform fees. Invest in funds, which can mean more K1s from different states, potentially higher fees, but diversification. Wait until they have substantially more capital to diversify across direct deals or accept being under-diversified within their private real estate allocation.
That's a difficult trade-off. No easy answer.
It really isn't. Another practical reality is the long time to get money fully invested capital calls.
What do you mean?
Even after you've committed capital to a fund and wired your initial money, it can take weeks or even months for that capital to be fully deployed into specific properties. One investor cited an example where it took 58 days from the date they wired money until it was actually deployed in the deal.
So your money is just sitting there not earning anything for almost 2 months.
Potentially, yes, experiencing cash drag.
Yeah.
Furthermore, especially in equity funds, the manager might not call for all the committed capital up front. They might call for, say, 50% initially, and then make subsequent capital calls over the next 6, 12, or 24 months as they identify and close on new properties.
So you have to keep cash ready for when they ask for it?
Exactly. This makes managing your overall asset allocation tricky, as you have capital committed but not yet earning a return, and you need to be prepared to fund those capital calls, sometimes with relatively little notice.
That definitely adds complexity to managing your cash flow and asset allocation strategy. Feels less predictable.
It is less predictable. Then there are the documents themselves, lengthy PPMs. We discuss their content, but they are often 100 to 200 pages or more. They are the legal contract for the partnership.
Right, the operating agreement.
And as one source frankly put it, they are written by the partnership's attorney to protect the general partners from you coming after them.
So essential reading, but structured primarily to protect the issuer, not necessarily the investor.
That's often the reality, yes. And within those documents, or inside agreements, you'll frequently find confidentiality clauses.
Well, NDAs, basically.
Pretty much. These are designed to prevent limited partners from publicly sharing information about the partnership, especially anything negative that could potentially harm its reputation or future fundraising efforts.
And the real-world consequence of those clauses, what does that mean practically?
As experienced investors noted, while managers are happy for you to share positive feedback, if you encounter problems, underperformance, or even suspect fraud, attempting to discuss it publicly online or in groups can result in a reminder that you signed a confidentiality agreement.
So it silences criticism.
It can certainly limit transparency within the investor community and potentially lead to a more positive public perception of the asset class that might be warranted, as negative experiences are less likely to be widely shared. Good news travels, bad news is often kept quiet.
That's a critical point about the information flow. What about control over your investment decisions? Do you get a say?
As a limited partner, LP, in a fund or syndication, you have essentially no control. Zero.
None.
Pretty much none. The fund manager, the general partner or GP, makes all the decisions what properties to buy, when to sell them, how they are financed, how they are managed, when distributions are made. They might decide to sell a property sooner or later than you would prefer.
Right.
And that sale triggers tax consequences for you, like capital gains or depreciation recapture, regardless of your personal tax situation or timing needs.
So you're a passive investor in the truest sense, just along for the ride based on the manager's decisions.
That's right. You get updates, maybe quarterly webinars, but as one investor lamented, you feel stuck in it for years, whether I like what they're doing or not. You can't just fire the manager or vote to sell a property.
This next one is a practical but significant consideration for estate planning.
Mhm.
These investments can be a complex mess for heirs.
Oh, absolutely. This is often overlooked. If you pass away holding multiple private real estate investments in different structures and states, it can create a significantly more complicated situation for your estate and heirs compared to easily liquidated public assets like stocks or mutual funds. It can add considerable time, legal fees, and accounting costs during the probate process. Your executor needs to figure out the structure, the value, the transfer process, deal with a GP.
Compared to just handing over brokerage account statements for public assets, much simpler.
Exactly. Public assets are liquid and relatively simple to value and transfer or sell. Private investments require specific paperwork, understanding the fund structure, and coordination with the fund manager. Furthermore, your heirs might not be accredited investors themselves, which could complicate their ability to hold or manage the asset if it requires that status.
Another hurdle.
Right. And using a trust can help manage the probate process, but often doesn't eliminate the multi-state tax filing headaches associated with the underlying properties. The trust itself might still have to file in multiple states.
What about evaluating the manager's track record? Is that straightforward? How long have these guys been around?
Not always easy. A common challenge is short track records. It's considered quite good if a private real estate fund or company has a track record of 7 years or more.
Only 7 years is good.
Relatively speaking, in this space, yes. A 15-year track record covering multiple market cycles is quite rare. While the principals leading the fund might have been in the industry longer, the specific fund's or company's operating history can be limited.
Meaning you might not see how they perform through a full real estate downturn or recession, like back in '08.
Exactly. Many newer funds haven't been tested through a significant downturn. Evaluating performance solely based on an upmarket track record is risky. Also, highly successful managers or firms might eventually take their company public or sell it, removing their long private market track record from the available pool of private managers you can invest with. They graduate, in a sense.
And finally, the tough reality that expectations often don't match reality. Overestimation of returns.
This came up frequently in the discussions. Private real estate investment offerings often present attractive projected returns, those pro formas we talked about.
Yeah, the nice-looking projections.
However, experienced investors noted it's more common to underperform the pro forma, and sometimes substantially, than to outperform it. One investor shared a specific example where a deal was projected to return 15–16% IRR.
Pretty good return.
But the manager reported 10% actual IRR, and when the investor calculated it themselves using the cash flows, they got 8.84%.
Whoa, that's a significant gap between expectation and reality. Almost half the projection in that case.
It is. The sources suggested that investors should often mentally discount projected returns and maybe expect to earn a little less than pro forma. They also noted that sometimes managers themselves might miscalculate metrics like IRR, either accidentally or maybe even strategically.
Wow. So it's not just about hitting the accredited investor mark, it's about navigating a landscape filled with significant practical hurdles, risks, and complexities that are very different from the public markets. This is a lot to take in.
It really is.
Our sources, particularly the online discussions, offered some real-world insights on how accredited investors actually find and approach these opportunities beyond just the theory.
Yes. The consensus was that finding the truly quality deals, especially those not on public-facing online platforms, heavily relies on networking. It's a networker's paradise, as one person put it.
Networking? How?
Suggestions included leveraging relationships with private bankers or wealth managers, particularly those at smaller boutique firms who might have connections to deal sponsors. Reaching out to other founders or CEOs you know.
Using your business contact.
Exactly. Joining industry associations like the Angel Capital Association or NVCA, National Venture Capital Association, or participating in local angel investor groups were all mentioned as ways to find opportunities through personal connections. Online communities and clubs specifically for accredited investors were also noted as potential sources.
So it's about who you know and actively seeking out those connections, getting into the right circles.
To a large degree, yes, especially for the deals that aren't broadly marketed using that 506C exemption. The issue of fees came up repeatedly in these real-world discussions as a major point of concern.
We keep coming back to fees.
Described again as terrible and awful, and being vastly higher than index fund fees, the opposite of Boglehead philosophy.
Even if some argue it's the cost of entry, the price you pay for access.
Yes, that perspective was there too. that high fees are simply what it costs to play in the sandbox of these complex, large-scale private deals where managers are doing a lot of active work.
Fair enough. Different perspectives.
Investors in these discussions also highlighted having different goals. Some are primarily seeking current yield or cash flow.
Like from core properties.
Yeah, or maybe private credit, hard money lending, niche private equity strategies, while others are focused purely on capital gains, looking for that big home run, like in venture capital or opportunistic real estate.
And those online platforms we mentioned, like Yield Street or Real Crowd, what was the verdict there?
Well, platforms using 506c exemptions can provide access and allow broader advertising, making it easier to find deals without needing the deep network. However, the concern about these platforms adding their own layer of fees on top of the underlying fund's fees was raised.
Double fees.
Potentially, yes. Which could make them less attractive than investing directly with a sponsor if you can find and access them.
Syndicate investing was mentioned as a way to access deals with potentially lower minimums, right? How does that work?
Yes. Investing through syndicates, sometimes found on platforms like AngelList for angel investing, though real estate syndicates exist separately, allows investors to pool capital behind a late investor. This can sometimes lower the effective minimum investment per person significantly, maybe down to $5K, $10 a day, or $25K in some cases.
Much lower than $100.
Much lower, making it possible to build a more diversified portfolio of individual deals sooner. You also often leverage the due diligence performed by the lead investor in the syndicate, though you still need to diligence the lead.
Any practical tips regarding those pesky state taxes that came up in the discussions?
Well, investing specifically in properties located in tax-free states like Texas or Florida was suggested as one strategy to reduce the multi-state filing burden, though that obviously limits your geographic diversification. While using a trust can help simplify probate, it doesn't necessarily eliminate the requirement for the trust itself to file state tax returns where the properties are located. Also, considering the overall tax reporting structure of the investment, whether it issues a complex K-1 or a simpler 1099 form, was mentioned as a factor for simplicity.
1099 is much easier.
Much simpler. Blackstone's Bright Fund, for example, was cited as an instance where a large private real estate investment issues a 1099, which is a big plus for many investors, compared to dealing with potentially dozens of K-1s.
That simplicity would be very appealing, given the complexity we discussed. Any other nuggets from the real-world chatter?
Finally, the sources noted that some funds, particularly very large ones or certain types of hedge funds that might also hold real estate, might require an even higher standard than accredited investor status. Qualified purchaser, QP status.
Qualified purchaser, higher than accredited.
Yes, generally requires having $5 million or more in investable assets, so another, even higher tier of access. Other avenues for finding opportunities mentioned included listening to specific niche podcasts, like one called Passive Investing from Left Field, subscribing to industry newsletters, and attending real estate investment conferences.
A lot to navigate, even for those who meet the accredited investor criteria. It's a whole different world. Let's dive a little deeper into the tax considerations before we wrap up. We touched on the multi-state K-1s, but the sources listed several other specific tax terms and issues relevant to private real estate funds.
Right. Beyond the logistical headache of multi-state K-1s, there are specific tax treatments and complexities embedded in these structures. We mentioned carried interest, the manager's profit share.
Yeah, the 20% or whatever.
Which is typically taxed at favorable long-term capital gains rates, assuming certain holding periods are met. That's a big tax advantage for the managers.
What about unrelated business taxable income, UBTI? You mentioned that briefly.
Right. UBTI is a significant concern, specifically for tax-exempt investors, like university endowments, charitable foundations, or even IRAs sometimes. Certain types of income generated within the real estate fund, particularly income derived from debt-financed property or from operating an active trade or business within the fund.
Like running a hotel within the fund?
Maybe, yeah. That income can be considered unrelated to the entity's tax-exempt purpose and become taxable income for them, even though they are normally tax-exempt. Fund managers have to structure carefully, often using those blockers we mentioned, to minimize or avoid UBTI for these important investors.
Okay, a specific issue for tax exempts, RPTA, you mentioned that too.
RPTA stands for the Foreign Investment in Real Property Tax Act. This is relevant when foreign investors are involved. It basically means that if a foreign person sells a U.S. real property interest, the gain is subject to U.S. income tax and potentially withholding tax.
Taxing foreigners on U.S. property gains.
Exactly. Funds with foreign investors might use specific structures, like investing through a domestically controlled REIT, where 50% or more is owned by U.S. persons, to help foreign investors avoid FERPA withholding and simplify their U.S. tax situation.
So specific rules and structures needed for foreign capital.
Definitely. And of course, revisiting those state tax issues, dealing with nexus, establishing a tax presence in a state just by owning property there, compliance requirements, and navigating varying state income tax rates where the properties are located. It's a maze.
Are there tax considerations related to setting up the fund itself or how expenses are handled?
Yes. There are rules regarding the amortization versus capitalization of organizational costs. This dictates whether the startup, legal, accounting, and filing fees for the fund can be immediately expensed or if they must be capitalized and deducted over several years.
Accounting rules.
Exactly. Interest expense limitations under Section 163J of the tax code can be relevant for funds that use significant debt financing, potentially limiting the deductibility of that interest expense, which impacts returns. There can also be management fee expense limitations depending on how the management company is structured and compensated, affecting whether those fees are fully deductible.
What about taxes that directly impact the high-income investors themselves?
High-income individual investors may be subject to the net investment income tax, NIET, which is an additional 3.8% tax on certain types of investment income, including passive income received from investments like these funds, for those above certain income thresholds. Around $200 single, $250K joint.
An extra tax bite for higher earners.
Yep. But on the flip side, are there specific real estate tax incentives that funds might use to benefit investors?
Yeah, anything positive on the tax front?
A notable one mentioned is investing in qualified opportunity zones, QOZs. These are economically distressed areas designated by states. Investing capital gains into a fund targeting QOZ businesses or real estate can provide investors with significant tax incentives.
Such as?
Including deferring tax on the initial capital gain invested until maybe 2026, getting a potential step up in basis on that deferred gain, and potentially excluding all capital gains from the QOZ investment itself if it's held for 10 years or more.
Wow, potentially tax-free gains on the new investment. That sounds powerful.
It can be, and it drove a lot of capital into those zones. It underscores that while there are many tax complexities, managers also leverage specific real estate tax provisions and structures, like QOZs or conducting cost segregation studies.
Well, segregation.
Yeah, that's where they hire engineers to break down a building's components, like carpet, fixtures, landscaping, into different depreciation schedules, allowing them to accelerate depreciation deductions, which creates larger tax losses to pass through to investors in the early years, sheltering income.
More tax savings upfront.
Exactly. So, optimizing after-tax returns is huge. Understanding the tax impact of things like how the preferred return and promote distribution structures work, the waterfall, and liquidation terms is also crucial, as how and when cash is distributed affects when and what type of tax you pay, income versus capital gain.
So tax planning and structuring are absolutely critical components of maximizing the net return in private real estate, even though it adds layers and layers of complexity.
Without a doubt. It's an area where expert tax advice is essential for both the fund and the investor. But being aware of these concepts is key for evaluating potential opportunities and understanding your actual take-home return.
Well, that was quite the comprehensive journey behind the velvet rope of U.S. private real estate funds for accredited investors based on the sources you provided. A lot to digest.
We started by defining that critical gatekeeper, the accredited investor, understanding who qualifies the income, the net worth, the professional credentials, and why that status exists. You know, the idea of reduced need for protection.
Right. Then we explored the world they access private real estate funds, looking at their strategies from core to development, the different legal structures they use like LLCs and LPs, and the crucial document that explains it all, the PPM.
We delved into how these deals are evaluated, highlighting key metrics like NOI and IRR, cash on cash, equity multiple. But perhaps more importantly, we spent a good chunk of time scrutinizing the fee structures, the management fees, the promote, the potential conflicts.
Yeah, and understanding the significant costs and how they can incentivize managers, even touching on that surprising historical context of carried interest compensation from Venetian sea merchants.
And crucially, we dedicated significant time to the often under-discussed practical realities and significant downsides, the fundamental illiquidity, that lockup period.
Huge point.
The high minimums, the headache of multi-state tax returns, the difficulty in finding and comparing deals in an opaque market, the absolute paramount importance and risk associated with the manager.
Betting on the jockey, not just the horse.
Exactly. Plus the challenges of conducting thorough due diligence and the lack of control and transparency compared to public markets, not to mention the complexity for heirs.
The core takeaway from this deep dive seems clear. Achieving accredited investor status does indeed open doors to unique, potentially high-reward real estate investment opportunities in the U.S. that are simply inaccessible to the general public. These can offer valuable diversification and the potential for higher returns than public market alternatives.
However, as we've seen in detail, this access comes bundled with a significant package of complexities and trade-offs. These demand serious due diligence on the part of the investor, a crystal clear understanding of the risks involved, the often high fees, the potential for complex tax situations, and the fundamental reality of long-term illiquidity.
It really is a different world.
It is, without question, a fundamentally different and more complex endeavor than simply clicking buy on a publicly traded stock or fund. Much more hands-on research needed.
So, to leave you with a final thought to consider, reflect on the historical origins of carried interest compensation, where it began as a share of profits given in exchange for taking on literally life-threatening risks sailing the high seas. How does that historical foundation resonate or perhaps contrast sharply with the compensation structures prevalent in modern private real estate today, where risks are primarily financial and operational, not typically life and death? What does that evolving relationship tell us about the alignment or potential misalignment of interests between managers and investors in private markets today? Something to chew on.
That was our deep dive into your sources on private real estate funds and the accredited investor world. We hope this conversation has provided you with a comprehensive and clear-eyed perspective on this fascinating, complex, and often challenging part of the financial landscape.